Welcome to the Deep Dive, where we take your sources, your articles, your research, our collective notes, and really try to extract the most important nuggets of knowledge and insight. Today, we're diving headfirst into a truly fascinating and I think, at times, intensely radical investment philosophy. We're talking about Nassim Taleb's renowned barbell strategy. Now, this is an idea that, for good reason, has captured the imagination of many. It proposes a starkly different, almost counterintuitive approach to managing wealth in, well, what we all know is an increasingly unpredictable world. For most of us, when we think about investing, it usually conjures images of, carefully balancing risk, diversifying our portfolios across various asset classes, stocks, bonds, maybe some real estate, and perhaps trying to beat the market with smart, informed decisions, often relying on historical data, economic forecast, expert analysis. We're sort of taught to find that sweet spot, that optimal risk-adjusted return. But Taleb, with his characteristic boldness, suggests something else entirely. Imagine, if you will, a literal barbell in a gym. At one end, you've got an immense weight, right? And at the other, a tiny, almost negligible weight. The barbell strategy asks us to essentially divide our capital into these two extreme poles. We put the vast majority of our eggs, maybe 90 to 95%, in the safest basket imaginable. Think ultra-secure government bonds, highly liquid cash, things like that. Capital preservation. Then at the other end, a very small, almost insignificant portion, maybe 5 to 10%, goes into extremely speculative, high-risk, high-reward opportunities. It's a strategy that deliberately, almost defiantly, avoids the middle ground of moderate risk, which Taleb argues is actually the most dangerous place to be.
And what's truly captivating here is how this philosophy fundamentally challenges the very bedrock of conventional financial wisdom, particularly how we perceive risk, how we quantify it, and ultimately how we manage it. It's undeniably intellectually coherent. Yes, it presents a compelling case against the dangers of what Taleb labels medium risk, that seemingly balanced, diversified portfolio that most financial advisors would recommend. He basically contends that this middle path, while it appears prudent on the surface, might actually leave you highly vulnerable to the truly unexpected. Those high-impact, low-probability events he famously calls Black Swans. So our deep dive today isn't just about understanding the theory behind it. The real question for you, the individual investor, isn't just whether it makes sense on paper as a kind of theoretical construct. It's whether it's truly a practical and sustainable approach in the messy, often emotional, real world. Given, the inherent limitations of human behavior, our psychological biases, our access or lack thereof to specific information.
Exactly. So our mission today is to thoroughly analyze this famous strategy, looking at it from both its powerful theoretical foundation and its often overlooked practical challenges. We'll start by exploring its intellectual strengths, understanding the robust logic behind why Taleb believes this barbell approach provides true anti-fragility, that ability not just to withstand shocks, but to actually benefit from them. But then we'll peel back the layers and delve into the significant practical difficulties of implementing it, especially for the average investor, who, let's face it, lacks institutional resources or vast networks. This includes the immense challenge of consistently identifying those elusive black swan opportunities that promise extraordinary payoffs with limited downside. And perhaps an even greater hurdle, the immense psychological discipline required to stick with such a seemingly inactive strategy through long periods of market noise, the temptation to chase fads, and what often feels like, financial inertia. It's a critique aimed at understanding if this powerful theoretical model is truly actionable and beneficial for you, our listener, or if its real wisdom lies more in its principles than its direct application.
The intellectual coherence of the barbell strategy.
Okay, let's jump right into the core of Taleb's thinking. The intellectual coherence, the elegance, really, of the barbell strategy. At its heart, it's a beautifully simple yet profoundly contrarian philosophy. It directly confronts our traditional notions of risk. The core concept, as we touched upon, is about combining extreme safety with calculated asymmetry. It proposes keeping the vast majority of your assets, let's say a significant 90 to 95%, maybe even more, in extremely safe, utterly low-risk investments. And when we talk about safe, we're talking about instruments that prioritize capital preservation above all else. Think government bonds from stable nations, highly liquid cash, money market funds, or very stable, low volatility instruments. These are the assets designed to provide that bedrock of security to ensure you can sleep soundly at night, knowing that a huge chunk of your wealth is protected from market downturns, economic shocks, and, the unpredictable vagaries of the financial world.
Right. And then at the other end of this metaphorical barbell, you take a very small, carefully defined portion, maybe 5 to 10%, perhaps even less of your total capital, and you place that into highly speculative, high risk, high payoff opportunities. Now, this isn't about hedging in the traditional sense, which usually means taking an opposing position to reduce potential losses in your main investment, like buying insurance. No, this is about positioning for positive asymmetry. The intellectual elegance lies precisely in this embrace of asymmetry itself. The downside on the speculative side is strictly limited, isn't it? It's limited to that small, defined bet. The maximum you can possibly lose on that end of the barbell. It's just that small percentage of your overall portfolio. But the upside, well, the upside is potentially unlimited. It offers the chance for truly transformative exponential returns if one of these long shot bets pays off in an extraordinary way. It's a deliberate, almost defiant rejection of what Taleb views as medium risk. He argues that this exposes you to all the volatility and potential losses of the market without offering the extreme upside needed to compensate for those unforeseen, high-impact events, the black swans. So the goal is really twofold. First, be robust to negative black swans, meaning your core wealth is protected from unexpected downturns. And second, simultaneously be positioned to benefit immensely from positive ones, those unpredictable, highly impactful events that can generate outsized returns and, frankly, redefine entire industries.
Okay, so if I'm getting this right, Taleb is essentially saying that the middle ground, where many of us are taught to diversify and spread risk, that's actually the most vulnerable spot. It's like being in the middle of the road during a storm. You're not safely on the sidewalk, but you're also definitely not in a fortified shelter.
That's a good analogy. Yeah.
And this is a radical departure, isn't it? It goes against what many of us have been taught about investing, and it directly challenges several foundational texts in finance. When we think of traditional investing, Burton Malkiel's A Random Walk Down Wall Street comes to mind immediately. It's a cornerstone. Malkiel meticulously discusses how adding more securities to a portfolio reduces unsystematic risk, which is, the risk specific to individual companies, things like a CEO making a bad call or a factory fire. By spreading your investments across many different companies and industries, you reduce the impact of one particular company tanks. This leaves only systematic risk, also known as market risk, the inherent risk of the overall market that generally you can't diversify away. He even mentions the capital asset pricing model, the CAPM, developed by Sharpe, Lintner, and Black as a tool to measure this systematic risk, often using beta as a key metric. Now, this is where Taleb fundamentally diverges, right? He doesn't just see systematic risk. He sees the unknown unknowns. These extreme events that traditional models, built on historical averages and predictable variations, simply cannot foresee or quantify.
Precisely. Conventional wisdom, as Malkiel and others articulate so well, seeks to optimize the risk-reward trade-off by finding a balance in the middle. It promotes creating a diversified portfolio that attempts to eliminate as much non-market risk as possible while earning a satisfactory, hopefully consistent return over time. The fundamental assumption here is that risk can be measured, it can be managed based on historical data, and that returns will follow a somewhat predictable, often bell curve-like distribution. The barbell strategy, however, essentially argues that this middle ground is precisely where you are most vulnerable to the truly unexpected. A traditionally diversified portfolio, while it seems prudent, is still built on a foundation of expected returns and risks, which are often derived from looking backward, from historical data. Taleb suggests that for many unforeseen events, those black swans that truly reshape markets, like the invention of the internet, 9/11, the 2008 financial crisis, a traditional diversified portfolio offers neither true safety. It's sinning because it's still exposed to market-wide shocks that these models tend to underprice the risk of. Nor does it offer the ability to capitalize on extreme opportunities because its bets are spread too thin across average performers. It's a portfolio designed for the predictable, for the known unknowns that can be statistically modeled, not for the truly unpredictable, the unknown unknowns that defy statistical forecasting. He's essentially saying that by trying to be moderately exposed to everything, you're perfectly exposed to nothing significant, neither protection nor massive upside.
That's a really powerful reframing of risk. And it brings to mind another classic, The Intelligent Investor by Benjamin Graham, a true cornerstone of value investing. Graham, as you know, points out the investor's inherent challenges, our own human fallibility in making judgments, and the fact that the market often already reflects predictable future results. He famously notes that the current market price may already fully reflect what he is anticipating when an investor tries to pick slightly better than average stocks. It's hard work. So how does the barbell strategy, with its extreme structure, attempt to address these deeply ingrained challenges, particularly that futility of trying to predict the market's predictable movements?
Graham's insights are absolutely crucial here because they speak directly to the deep-seated difficulties of active investing for the average person. And the barbell strategy, well, it attempts to bypass these very problems. By holding the vast majority of your assets in truly safe, low-yielding instruments, you effectively avoid the pitfalls of active stock picking, of trying to outsmart the market day to day, and that human fallibility Graham warns against. You're not trying to forecast predictable superior performance in the bulk of your portfolio. You're not attempting to outwit the market on a regular basis, which, as Graham highlights, is often just an exercise in futility. Then, on the speculative side, with those small, high-risk bets, you're not looking for predictable, superior performance either. Not really. Instead, you're seeking exposure to unpredictable, extreme outliers, those rare events where traditional analysis based on past data and expected outcomes has far less relevance. You're not trying to pick a stock that will outperform by 10% next year. You're looking for something, however unlikely, that could go up 100 times over a decade, recognizing full well that most of these bets will probably fail. This completely reframes the investment challenge. It moves away from forecasting what the market will do and towards positioning yourself to survive the worst and potentially profit enormously from the truly unexpected. It's about being robust rather than merely efficient or predictive.
I can definitely see how that structure offers a kind of shield against market noise and, well, human error. And this philosophy also seems to echo the wisdom of contrarian investors, doesn't it? It takes a clear page from their playbook on how to navigate market psychology. Howard Marks, in The Most Important Thing Illuminated, champions contrarian behavior. The idea of buying when others are fearful and selling when they are greedy. Classic advice. He explicitly warns against greed and optimism, leading people to pursue strategies promising high returns without high risk, which he sees as an illusion that often precedes market downturns. The barbell seems to embody this contrarian mindset in its very structure. It almost builds in the capacity for that kind of behavior.
It absolutely does. And this is where the barbell strategy finds a powerful alignment with contrarian principles, almost like a built-in structural mechanism for it. The large, safe portion of your portfolio allows you to largely sit out periods of market euphoria, when others are engaging in avid buying, pushing prices to unsustainable levels, driven by that greed and optimism Marx describes, while your protected capital remains stable and intact. This resistance to joining the herd not only preserves your dry powder, but it also gives you the psychological fortitude to watch others chase what might become overvalued assets without feeling compelled to jump in yourself. Conversely, the speculative portion, ideally, would be deployed or positioned during periods of panicky sellers, those times when fear has driven prices of potentially transformative assets to deeply undervalued levels. This is precisely when the immense upside potential, with relatively contained downside risk limited to that small slice of your capital, can potentially be realized. It's about being strategically prepared for and reacting to market extremes rather than trying to smoothly navigate that often misleading middle ground. By maintaining a large, safe base, you give yourself both the emotional and the financial capacity to act rationally and contrarianly when others are driven by fear or greed. It's essentially about buying when they hate them and selling when they love them, but with a highly specialized asymmetric approach.
The practical difficulties for the average investor a critique.
Okay, so we've just admired the compelling intellectual case for Taleb's barbell. It's a beautifully robust theoretical model, no doubt. But theory, as we often find, frequently collides with reality, especially for individual investors operating without, institutional resources or vast networks. Let's peel back the layers now and examine the significant practical hurdles, starting with perhaps the most fundamental challenge. How does one actually identify true Black Swan opportunities for those small, speculative bets? It's one thing to theorize about them, but quite another to find them in the wild, let alone consistently. Where do you even look?
This raises a profoundly important question, and it's really where the rubber meets the road, isn't it?
Yeah.
The very essence of a black swan, as conceptualized by Taleb, is its unpredictability, its rarity, and its extreme impact. By definition, you cannot plan for them, nor can you precisely predict their occurrence based on past data. So the idea of identifying them beforehand for investment is inherently paradoxical. It's a bit of a catch-22. Are we looking for something that is merely high risk, like, a biotech startup with a long-shot drug? Or are we looking for something that is genuinely a game changer with an unknown, often unknowable probability distribution? Most high-risk ventures are simply that. High risk. They have no real black swan potential. They're just likely to fail, perhaps with modest upside if they succeed, but not that astronomical upside. The historical record is absolutely littered with companies that were high risk and just fizzled out, not companies that were black swans that didn't materialize. It's a tough search.
That's a crucial distinction, high risk versus true Black Swan potential. And this difficulty is further underscored when we consider how genuine innovation and disruptive change typically unfold. Blitzscaling talks about these non-obvious opportunities that arise from a change in the market that the incumbents aren't willing or able to adapt to. They cite examples like Charles Schwab leveraging deregulation. While those are compelling stories, as you just highlighted, these opportunities are often recognized clearly only in retrospect after the fact. Hindsight is 2020. Is that what we're expected to look for as individual investors? Are we supposed to be spotting these tectonic shifts in the specific companies that will capitalize on them before anyone else with, a limited budget and no inside track? It feels like trying to find a needle in a haystack, maybe blindfolded.
It absolutely does.
hmm
And your analogy of a blindfolded search is pretty apt, I think. While blitzscaling highlights how companies like Schwab can capitalize on disruptive shifts or deregulation to gain significant advantage and achieve massive scale, for an individual investor predicting which nascent opportunity will become the next Amazon or Google, well, it's incredibly difficult. It almost borders on needing psychic powers. The vast majority of new technologies, or major shifts, as mentioned in blitzscaling, simply fail to achieve significant scale or impact. They just don't pan out. For every Netflix that successfully adapted and dominated, there are countless others that just didn't make it. We don't even remember their names. To consistently identify the right small, speculative bets that actually have that black swan upside requires either immense expertise in a specific domain, maybe significant inside information about nascent industries, or frankly, sheer extraordinary luck, none of which are readily available or reliably repeatable for the average investor. And, the richest man in Babylon offers that timeless warning. Gold slippeth away from the man who invested in businesses or purposes with which he is not familiar.
Right, or which aren't approved by those skilled in its keep.
Exactly. Many of these speculative bets would fall squarely into that category for most people, leading to losses far more often than black swan windfalls. It's really a game for insiders, venture capitalists, people with deep domain expertise.
That paints a pretty stark picture of the black swan hunt. Okay, so moving beyond just identifying them, another significant practical difficulty is what we might call the small bet paradox. This is intricately linked to the challenge of capital allocation. The strategy calls for small speculative bets, a tiny portion of your overall wealth dedicated to these high upside ventures. But how do you define small in a way that truly limits your downside exposure to a trivial amount, yet still allows for a meaningful, maybe even life-altering impact if one of those bets pays off massively? Let's take a listener with a relatively robust portfolio, say $100,000. A 5% bet is $5,000. Is that $5,000 investment enough to be truly transformative if it doubles or triples, even if it goes up, say, 10x to $50,000, which is a phenomenal return on that specific bet? How much does it really move the needle for your overall financial picture when most of it, $95,000, is just sitting in safe assets?
It's a critical allocation problem, and it often gets glossed over in the theoretical discussion. It becomes even more pronounced when you actually run the numbers. For a truly black swan event, to meaningfully impact the overall safe portfolio, the payoff from that tiny portion would need to be absolutely astronomical. We're talking maybe 100x, 1,000x, or even more. Let's stick with your example. If your $5,000 bet turns into $50,000, that's a fantastic 10x return on that specific investment, no question. However, if that's part of a $100,000 portfolio where $95,000 is in safe assets, your total portfolio only increases by $45,000, bringing it to $145,000. Now, that's a 45% increase on your overall portfolio, which is excellent by any standard, don't get me wrong. But for it to be truly transformative, or to significantly shift your financial trajectory, especially if someone is starting with a smaller capital base, it still requires that astronomical initial return multiplier. So what does this all mean for someone with, say, limited capital, or even a solid but not enormous portfolio? The effort, the research, the sheer risk involved in finding and executing these small bets might not actually justify the potential, though highly uncertain returns, given their relatively modest impact on a smaller overall portfolio. The strategy, in its purest form, might be much more accessible and impactful for those with larger capital bases, we're talking millions, who can deploy significant amounts across a wider array of small bets, or who have institutional access to unique pre-IPO or early-stage ventures that offer this kind of extreme asymmetry. It becomes a scale problem for the individual investor.
So even if you could spot a black swan, Making it impactful with a truly small bet is another hurdle, okay? But perhaps the biggest hurdle, maybe overriding even the difficulty of finding black swans or the capital allocation paradox, is the immense psychological discipline required to actually stick with the barbell strategy. It demands long periods of what essentially feels like inactivity for the vast, safe portion of your wealth. You're not actively trading, you're not chasing the latest hot stock, you're not constantly rebalancing in response to daily news. It demands the patience to wait, possibly for years, for genuinely rare, high-payoff opportunities without getting caught up in market fads, the constant news cycle, or that fear of missing out, FOMO, which is so powerful. This clashes profoundly with fundamental aspects of human nature, doesn't it? Our innate desire for action, our susceptibility to social proof, our craving for immediate gratification. How do you even begin to cultivate that kind of stoicism?
If we connect this to the bigger picture of human behavior and economics, it becomes really clear why this is such a formidable challenge. John Maynard Keynes, way back in the general theory, spoke of the need for a far-reaching change in the psychology of investment markets to avoid wide fluctuations. Taleb is effectively asking individual investors to embody that profound psychological shift on a personal level to fundamentally alter their relationship with money and market activity. And the pressure to do something with your money is just immense, isn't it? You're constantly bombarded by headlines touting the next big thing. You see friends or colleagues maybe bragging about quick gains. You hear financial commentators discussing every market twitch.
All the time.
Yeah. Now, The Millionaire Next Door provides a fascinating counterpoint here. It shows that most millionaires are not active traders. A significant chunk, 42%, made no trades at all in their stock portfolios in the year prior to being interviewed. This certainly suggests patience is key. But the barbell strategy requires a different kind of patience, not just holding existing diversified positions, but actively waiting for the extreme, for the truly outlier opportunities, and resisting the urge to deviate from the strategy's strict, largely inactive parameters. It's an active disengagement from the incessant noise, a deliberate choice for inertia on one side of the barbell, which is very counterintuitive for many.
It really does go against our natural inclinations to constantly engage, to seek new information, and to feel, I don't know, productive with our investments, doesn't it?
Yeah.
Our brains seem wired for pattern recognition and action. Cal Newport's Deep Work Rules emphasizes the importance of planning and committing to specific tasks to free up cognitive resources and avoid unresolved tasks battling for our attention. Similarly, Ray Dalio's Principles talks about specifying decision-making criteria and algorithms to make more informed and less emotional decisions. Can these principles of discipline and systematic unemotional thinking be truly applied by the average person to overcome the deeply ingrained psychological challenges inherent in the barbell strategy, especially when it comes to that long, often incredibly boring wait?
That's a crucial point, and it speaks directly to the immense challenge of behavioral finance. Yes, Dalio's approach of using algorithms suggests a powerful method to remove human emotion and bias from the investment process. That's what he aims for at Bridgewater. To successfully implement the barbell strategy, an investor would need an almost algorithmic discipline, a strict, unwavering rule for the vast, safe portion, and a rigorously defined, perhaps even pre-committed, unemotional process for identifying and executing the small, speculative bets. But it's far from easy. We are constantly battling cognitive biases, confirmation bias, seeking out information that confirms what we already think, availability bias, overestimating the likelihood of events that are easily recalled, like a recent big win someone talked about, and just the sheer action bias, that urge to do something, anything, even when doing nothing, is the optimal strategy. As Howard Marks notes, greed and optimism repeatedly lead people to pursue strategies they hope will produce high returns without high risk. Precisely the illusion the barbell seeks to puncture. Resisting this allure during boom times and resisting panic during busts requires an extraordinary level of self-control, mental fortitude, and a deep understanding of one's own biases that, frankly, few possess. It requires an unshakable commitment, rather than constant emotional reevaluation driven by fear or greed. The average investor is constantly being nudged by the market, the media, even their own internal impulses, making this kind of steadfastness exceptionally difficult to maintain over the long haul, over decades potentially.
Broader implications for your investment journey.
Okay, so we've dissected the intellectual brilliance and the formidable practical hurdles of the barbell strategy. Now, what does this all mean for you, the listener, in your own investment journey, even if you decide not to adopt the barbell strategy wholesale? Thinking about Nudge by Thaler and Sunstein, it reminds us about choice architecture, how the way choices are presented, the default options provided, can significantly influence our decisions. Are we, as average investors, subtly nudged away from radical, perhaps more robust long-term strategies like the barbell, and towards more conventional, often less extreme approaches, simply by the way financial products are designed or discussed in the mainstream?
That's a very perceptive point, and it really highlights the pervasive, often invisible influence of our environment on our financial decisions. Think about the default options, like the pre-selected, diversified target date funds in most 401k plans, or the balanced recommendations you get from robo-advisors. These are forms of choice architecture. They subtly, yet powerfully, guide us toward a middle-of-the-road approach. The media, too, reinforces a constant need for engagement and action, presenting investing as an ongoing activity, a game to be played, rather than a long-term, often passive commitment.
Right, creates a sense of urgency.
Exactly, a tyranny of the urgent over the truly important. Understanding these external nudges, as well as our internal human fallibility, as Benjamin Graham so wisely observed, is the first and most crucial step. It's about making more conscious, intentional choices rather than just reacting to defaults or market noise. It encourages critical thinking about why we invest the way we do, not just passively accepting what we invest in. It's about becoming aware of those invisible forces shaping our financial behaviors and recognizing that simply following the herd isn't necessarily the path to superior outcomes or even true robustness.
And even if the full barbell strategy, with its extreme poles, seems impractical for most of us, that data from the millionaire next door really resonates. The finding that successful investors tend to be long-term holders and make very few trades. Most millionaires, according to that research, don't follow the market day to day, and a significant percentage make zero trades in a given year. This suggests that patience itself, even without the wild swings of the speculative end of the barbell, is an incredibly powerful investment virtue. It's really about letting time and compounding do the heavy lifting, isn't it?
It absolutely is, and this highlights the crucial, often underestimated role of patience and a long-term perspective in genuine wealth accumulation. Regardless of whether you adopt Taleb's full barbell or not, the underlying lesson of avoiding constant activity and allowing investments to compound over decades is invaluable. The inactivity of the safe portion of the barbell isn't just about waiting for black swans, it's also about preventing yourself from making impulsive, value-destroying trades based on market noise or emotional reactions. Fear and greed drive bad decisions. It reminds you to resist that scramble to exploit risk to earn greater returns that Malkiel discusses, which, for most active traders, often leads to underperformance due to fees, taxes, and just plain bad timing.
Yeah, the friction costs add up.
They really do. True wealth for many is built through consistent saving, disciplined holding, and letting time and compounding work their magic, rather than through constant tinkering or trying to time the market. It's about recognizing that often the most productive thing you can do for your portfolio is simply nothing at all. Let it grow.
So, perhaps the true lesson for our listeners isn't necessarily to perfectly replicate the barbell strategy in their own portfolios, which, as we've established, can be immensely challenging for all the reasons we've discussed. Instead, it might be about incorporating its underlying principles, adapting them to their own unique circumstances, risk tolerance, and capacities. What's maybe one key takeaway for listeners about managing their own investments, especially in light of Taleb's radical ideas, that they can truly apply in a practical way?
I think the most profound and actionable takeaway is probably this. Focus intently on what you can control and cultivate a deep appreciation for positive asymmetry in your decision-making, not just financially, but maybe in all aspects of your life. You can absolutely control your consistent saving habits. You can control minimizing fees on your investments. That's huge over time. You can control having a clear, honest understanding of your own true tolerance for risk and your behavioral biases. Know thyself, right? And while identifying black swan investments might be too challenging for the average person, you can still seek out opportunities with positive asymmetry in your own financial life in other ways. This might manifest in career choices. Acquiring niche, valuable skills could lead to disproportionately higher earning potential with a calculable investment of time and money in education or training. That's an asymmetric bet. Or it could be in small entrepreneurial side ventures where the downside is strictly limited, maybe your time and a small capital outlay, but the potential upside could be significant and nonlinear. Don't fall into the trap of believing that moderate risk is inherently safe. Critically evaluate where you might be exposed to negative black swans without commensurate upside. By understanding the logic of the barbell, even if you don't apply it directly to your portfolio structure, you gain a powerful framework for thinking about robustness, opportunity, and the true nature of risk in a complex, uncertain world. Outro.
So today, we've embarked on quite a deep dive into Nassim Taleb's barbell strategy. We've admired its intellectual rigor, its compelling argument for providing robustness against the unpredictable, but we've also acknowledged the immense practical and psychological demands it places on the average individual investor. It's a strategy that fundamentally forces us to rethink what risk truly means and how we confront uncertainty.
The tension between that theoretical elegance and the real-world application is indeed profound here, isn't it? For the individual, the question of consistently identifying true black swan opportunities, of properly sizing those speculative bets, and crucially, of maintaining such unwavering psychological discipline. Well, it's a significant hurdle. It's one that institutional investors with vast resources, specialized knowledge, and often unemotional algorithmic systems are perhaps better equipped to address. The human element, as always, complicates even the most logical strategies.
Ultimately, the barbell strategy forces us to critically reevaluate our relationship with risk and uncertainty in what feels like an increasingly chaotic world. It's a powerful framework for understanding extreme events and positioning for them, even if its direct, perfect implementation is challenging for many of us. It encourages a deeper look into what true safety and opportunity really entail in our own lives, beyond just a diversified portfolio. So, what stands out to you about this deep dive into the barbell strategy? What part of this radical philosophy challenges your existing beliefs or perhaps reinforces them in a new way?
And this raises, I think, an important final question for all of us to consider. In a world saturated with information, constant financial news, and this pervasive pressure to be constantly doing something with your investments, is the most radical and perhaps ultimately the most effective act of all simply disciplined patience? Is it the courage to do nothing with the vast majority of your capital while remaining vigilantly prepared somehow for the true outliers? Something to think about as you consider your next financial move.